For almost 50 years, Bernard Madoff was one of the most respected men on Wall Street. He had served as chairman of the NASDAQ stock exchange 3 times. Charities trusted him with their endowments. Retirees trusted him with their life savings. Some of the smartest investors in the world trusted him with billions. On December 11, 2008, he was arrested in his own apartment. $65 billion, 37,000 victims, 48 years. This is how it happened. Anatomy of greed. What you're about to see lasted 48 years. 37,000 investors trusted this man with their savings. And for most of that time, the people who were supposed to protect you looked the other way. Her name was Carol Weiss. She and her husband had spent 30 years running a small furniture business in New Jersey. When they retired in the early 1990s, a friend introduced them to a money manager who promised something rare: steady returns, year after year, regardless of what the market was doing. His name was Bernie Madoff. Carol and her husband invested almost everything: the proceeds from selling their business, their retirement accounts, even a portion of money set aside for their grandchildren's education. She wasn't reckless. She was trusting. On the morning of December 11th, 2008, Carol turned on the news and heard her investment manager's name on national television. Not as a success story, as a fraud. She was not the exception. She was the rule. To understand how one man hid this for almost 5 decades, we need to go back to where it started, long before Wall Street ever heard his name. Bernard Madoff founded his firm in 1960 with $5,000 he had saved working as a lifeguard and installing sprinkler systems. He was 22 years old. Bernard L. Madoff Investment Securities started small, a legitimate market-making business, helping buyers and sellers of stocks find each other. And by most accounts, for years, it actually was legitimate. Madoff was, by every measure, a genuine pioneer. He helped develop the technology that would eventually become NASDAQ, the second largest stock exchange in the world. He served as its chairman not once, but 3 separate times. This is the detail that made everything that followed possible. Bernie Madoff was not an outsider running a scheme from the shadows. He was the establishment. He sat on regulatory committees. He advised the SEC on market structure. He was, by every visible measure, one of the most trusted men in American finance. At some point, investigators still debate exactly when, though evidence suggests as early as the 1970s, and almost certainly by the early 1990s, Madoff began managing money differently, not through his legitimate trading business, through a separate, secretive investment advisory arm, operated out of a different floor of his own building. That separate business promised something every investor dreams of: consistent annual returns of 10 to 12%. Not occasionally, not in good years, every single year. Through recessions, through market crashes, through the dot-com bubble bursting in 2000, through everything. Word spread quietly. Madoff didn't advertise. He didn't pitch. Access to his fund became a status symbol. Country clubs in Florida and New York, Jewish philanthropic circles, where Madoff was deeply embedded, all became unofficial recruiting grounds. Being invited to invest with Bernie Madoff was treated as an honor. By the 2000s, Madoff was managing an estimated $65 billion. Pension funds, university endowments, major Hollywood figures, European banks, and thousands of individual retirees like Carol, who had simply trusted a friend's recommendation. But there was a problem hiding inside those impossibly perfect returns. A returns pattern that, mathematically, should not have been possible. And at least one person had noticed, years before anyone listened. His name was Harry Markopoulos. He was a financial analyst, not famous, not powerful, working for a rival investment firm in Boston. In 1999, Markopoulos was asked by his employer to try to replicate Madoff's investment strategy. Within hours, he concluded it was mathematically impossible. The returns Madoff reported simply could not exist in a real market. He submitted a formal complaint to the Securities and Exchange Commission, the SEC, the federal agency that exists specifically to investigate exactly this kind of fraud. Nothing happened. Markopoulos submitted another complaint in 2001. Then, in 2005, this one nearly 20 pages long, titled, without exaggeration, "The World's Largest Hedge Fund is a Fraud." He laid out 29 separate red flags. The SEC investigated, briefly, superficially, and closed the case without finding wrongdoing. He submitted again in 2007, and again in early 2008, just months before the scheme finally collapsed under its own weight. 4 formal warnings, over nearly a decade, to the one agency in the United States government whose entire purpose is to catch exactly this. Madoff's reputation did the rest. He was a former NASDAQ chairman. He sat on SEC advisory panels himself. Several SEC investigators, by their own later admission, found it difficult to imagine that a man so embedded in the institution could be deceiving it. The fraud wasn't hidden by sophistication. It was protected by reputation. Now we get to the mechanism. What Bernie Madoff actually did with $65 billion of other people's money. The answer is almost nothing. He didn't invest it. Madoff was running what's known as a Ponzi scheme, named after Charles Ponzi, a different con artist from the 1920s. The mechanism is simple to explain, even if the scale here was almost impossible to comprehend. Imagine you tell investors you'll generate steady returns. New investors send you money. Instead of investing it, you simply hold it. When earlier investors ask for their statements, you send them fabricated documents showing impressive gains. When they ask to withdraw money, you pay them, using money from newer investors. As long as more money keeps coming in than going out, the illusion holds. Nobody questions it. The statements look real. The returns look real. For this to work for 50 years, at a scale of $65 billion, required infrastructure most people don't associate with fraud. Madoff employed a team on the 17th floor of his building who knew nothing about the scheme, running his legitimate trading business as cover, and a much smaller, separate team on the 19th floor who generated the fake statements. Frank DiPascali, Madoff's chief financial lieutenant, later testified that fabricating decades of false trading records by hand, using outdated computer systems specifically chosen because they wouldn't leave a modern digital trail, was essentially a full-time forgery operation. Auditing firms were supposed to catch this. Madoff's fund was audited every year, not by a major firm like Arthur Andersen or KPMG, but by a tiny 3-person accounting office in a strip mall in New York, with one active accountant. That single firm certified $65 billion in assets year after year, without ever raising an alarm. And the feeder funds, investment firms that funneled billions of their clients' money to Madoff, collecting enormous fees for the privilege, rarely asked deeper questions either. Some of them, internal records later showed, suspected something was wrong and chose not to look closer. The fees were too good. Every institution that was supposed to be a checkpoint became instead a conduit. The damage from Madoff's fraud reached far beyond Wall Street and far beyond Carol's living room in New Jersey. Madoff was deeply embedded in Jewish philanthropic communities in New York and Florida. He served on boards. he was trusted implicitly. And dozens of charitable foundations, built over decades to fund scholarships, hospitals, and humanitarian work, had placed significant portions of their endowments with him. The Elie Wiesel Foundation for Humanity, founded by the Nobel Peace Prize-winning Holocaust survivor and author, lost the vast majority of its assets, money intended for genocide prevention education and humanitarian work. Some charitable foundations closed permanently within weeks of the scandal breaking. Scholarship programs ended. Grants that had been promised were simply never paid. The damage didn't stop with institutions. Some individual victims, after losing their life savings, took their own lives in the weeks following the collapse, including a French money manager who had personally invested his clients' funds with Madoff and felt he could not face them. Bernie Madoff had spent 50 years building something that looked, from the outside, like generosity, wisdom, and trust. He called the statements profit. They were someone else's money, the whole time. The scheme didn't collapse because regulators finally caught it. It collapsed because of arithmetic. In late 2008, the global financial crisis triggered by the collapse of Lehman Brothers caused panic across every market. Investors everywhere needed cash. Madoff's clients were no exception. They began requesting withdrawals at a pace the scheme had never faced before. For a real investment fund, this would have been manageable. For a Ponzi scheme with no real underlying assets, it was fatal. There was no more new money coming in to cover what was going out. On December 10, 2008, Bernie Madoff told his two sons, who worked at the legitimate side of the firm and had no knowledge of the fraud, that the business was, in his own words, one big lie. He told them it was, essentially, a giant Ponzi scheme. His sons reported him to federal authorities the next morning. On December 11, 2008, FBI agents arrived at Madoff's Manhattan apartment. He reportedly told them there was, quote, no innocent explanation. He was charged with securities fraud. The scale of the fraud, initially estimated at $50 billion, later revised upward to $65 billion, when accounting for fabricated paper gains, made it instantly the largest Ponzi scheme in history. Carol, like thousands of others, learned the news the same way most of the country did. On television, in real time, with no warning. There was no slow leak, no gradual decline in the stock price, no quarter of disappointing earnings. One day, the money was there. The next day, it had never existed. Let's look at what accountability looked like. In March 2009, Bernie Madoff pleaded guilty to 11 federal felony counts, including securities fraud, mail fraud, wire fraud, and money laundering. He did not go to trial. He admitted everything. In June 2009, he was sentenced to 150 years in federal prison, the maximum allowed by law. The judge stated the sentence was intended to reflect the breathtaking scope of his crime. Madoff died in federal prison in April 2021 at the age of 82. He served just over 12 years of his sentence. A court-appointed trustee, working for more than a decade, eventually recovered approximately $14 billion of the estimated $17 billion in actual principal that victims had invested, through lawsuits against banks, feeder funds, and people who had profited from the scheme. It remains one of the largest financial recoveries in American history. And Carol? Through the recovery fund, she eventually received a partial return of her original principal, a fraction of what she and her husband had spent 30 years building. 30 years of work. A fraction returned, 2 decades late. Before we close, 5 things you should take with you. 1. Be suspicious of any investment that produces steady, positive returns, no matter what the broader market is doing. Markets go up and down. Madoff's reported returns almost never did. Consistency that defies market logic is not skill. It's usually a sign that the numbers are fabricated. 2. Be cautious of any manager who won't explain their strategy in plain language. Madoff described his approach in vague terms and discouraged questions. Legitimate fund managers can explain clearly how they generate returns. If the explanation is deliberately vague, that vagueness is the point. 3. Check who audits an investment fund. A $65 billion operation was certified every year by a 3-person accounting firm operating out of a strip mall. The size of an auditor should match the size of what it's auditing. If it doesn't, ask why. 4. Be wary of investments framed as exclusive privileges rather than transparent business arrangements. Madoff's funds spread through social trust and scarcity. Being invited in felt like an honor, which made people far less likely to ask hard questions. 5. Remember that regulators are not infallible. Harry Markopolos submitted 4 detailed, mathematically rigorous complaints to the SEC over nearly a decade. They were ignored. Due diligence is not someone else's job to do for you. Verify independently, even when an institution tells you everything has already been checked. Bernie Madoff was not a con artist who fooled unsophisticated people. He fooled regulators, bankers, charities, and some of the most experienced investors in the world for almost 5 decades. Trust, once it becomes absolute, stops being scrutinized. And that is exactly what he was counting on. The next episode covers a 30-year-old who dropped out of Stanford with an idea that could save millions of lives. She raised $9 billion. She appeared on the cover of Fortune, Forbes, and Time. And the technology never worked. Not even once. Anatomy of Greed.